You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Good morning, everyone. Welcome to the Perth Property Show. My name is Rentvesting, your host. As always, today we have Damon and Sugden back in the studio. You've been in a few times in the last couple of months, Damon, but I get you in because you're a good chat. You're a fun guy to hang around with.
Always enjoy coming in for a chat, Trent.
Mate, we're talking about Rentvesting today. It's been something we've referenced over the last couple of years. We haven't done a deep dive into why you do it and how it works, what the pros and cons are, both on a financial and a lifestyle situation. But we've had a few people calling us recently saying, we'd like to invest in property, and they don't have any free equity outside of the 80% loan-to-value ratio that a bank would want on their home. They've got equity in their home, but no more. Not really much more than you would need just to have that loan without paying lender's mortgage insurance. So, for example, they'll have a $500,000 house with a $400,000 loan. Therefore, they'll get $100,000 in equity, but none of that they can use on an investment. The answer to that is rentvesting. The idea there is that whilst you might not have the free equity with the house that you've currently got, that you live in your home, you do have equity, and you can unlock that by selling that property, using that cash, equity that's now turned into cash, as your deposit for your investment, and you go rent. That's the point, right?
Yeah, it's interesting. And I think, as all things, the actual structure of how you originally set yourself up in your initial property purchase is also just as important as how you're going to structure the next purchase, if that makes sense. Back on my soapbox about seeking advice from the mortgage broker is probably a good starting point with this one when you're buying your first home, and how you structure the loan and how you look to accelerate the repayments of that. Two options are, let's make some additional repayments to the actual loan itself, or we can set up a home loan offset account, which can provide you a lot more flexibility and I guess a little bit more protection from the banks as well, if they'd not likely, but if they called you in.
Exactly
on the
right.
Additional repayments.
Having that flexibility might mitigate your need to be a rent investor by repaying more as an offset that you can use to take that cash out and be a deposit somewhere else. But let's say we don't have that. Let's say that all of our equity is tied up in our home, and we're adamant that our home's not going anywhere and we want to invest somewhere else. We want to either do a development or passively invest somewhere, get some good positively geared rental income, and because we know we can rent somewhere pretty cheap. The idea here is that we all have a cost of shelter. We all personally put a price on our head, if I can say it that way, to have a roof over our head. For example, I rent in a 2-bedroom, 2-bathroom apartment in Northbridge with my wife. We pay $350 a week. Now, that's pretty cheap. We got a good deal there. I would like to think that mortgage on that property that the owner has of our landlord is probably costing them about $500 a week. It was quite an expensive apartment. Now, we're winning in that situation because 1, we don't have to pay rates. 2, we don't have to pay maintenance. And 3, we have the flexibility on a 6-month or annual basis that if we want to up and move, we don't have to pay selling fees or capital gains tax to go somewhere else. And what we do is we use the cash that we do save, that we do have, to invest in properties that have no connection to whether we'd like to live there or not. They're made purely for investment decisions, either as a development or a hold into the future. Now, there's some pros and cons to that, right? Owning your own home, a lot of people want to live in the home that they live in. They want to have that autonomy. They don't want to be told what to do. They don't want to have someone rifling through their house every 2 months as an inspection. And that's a decision personally you have to make. And when you have kids, I'm sure, Damon, you can impart here, it can be pretty hard when you've got kids to rent if you otherwise financially wouldn't need to.
Yeah, owning a home can be a significant personal goal for a lot of people, and sometimes it makes a lot of financial sense for a family group to do that. For others like yourself, when especially on such a sweet deal,
yeah,
it makes a lot of sense to go the other way. But there's emotional factors that can't come into play there, and it is simply, I own my home. I
can't get kicked out.
Yep, I can't get kicked out provided I don't default on my mortgage payments, and it just gives me a sleep at night factor. I can do whatever I want to the property that's going to suit me personally without having to consult the landlord every week if I want to do something. So I think it's a way up of both the financial and the personal, emotional levers that are involved in these decisions.
They're two sides of a coin, right? And I guess if you don't have to make that decision to be a rent investor, then lucky for you, right? But in this situation we're talking about today where you've got limited equity, your servicing's fine, right? But you've got limited equity to go and purchase another property, and you've made that choice that the property you've got isn't really working for you financially, and you're all about the financial outcome, then it's about divesting the assets that aren't working for you and reinvesting into assets that will work for you. And that's what rent vesting is as an option, right? So it also helps on your tax as a tax effective way of having debt. For example, an owner occupied property where you're using that debt to invest, because every home that we have, even if we live in it, that's still an investment, right? But it's not tax deductible.
And conversely, nor is it tax payable or taxable when you do sell it. You get the
and there's a benefit as well, right?
CGT free there.
If your home is a good investment as well, it's fantastic because you're not paying capital gains tax. However, if it's not a great investment, on the flip side, then there won't be much capital gains tax to pay because you wouldn't have made much capital gains, and you're not getting any deductions on interest payments there. With the mortgage on an investment property, if you own that property for over 12 months, you'll have a 50% discount on the capital gains that you'll pay tax on, which is helpful. But also, you'll have tax deductibility up, still at this stage with regards to negative gearing and things like that on your interest payments, something that you can't get with your owner-occupied loan. So when it comes to the idea of maximizing the efficiency of your tax situation with regards to the allocation of your debt, because it's all debt, whether it's your home or an investment property, the investment property is working, right?
Yeah, and the flip side of the rent vesting equation is a lot of our clients maybe they've successfully paid off the majority of their home, or there is a loan, and they've been making repayments, as I alluded to before, directly into the loan balance. And it's like, okay, well, kids are growing, time to upgrade, upsize the home. But they're really keen on keeping the original homes, their first home, a lot of memories there. They want some sort of connection with it. So they think, well, great, let's convert that into an investment property. So they pull out the additional loan repayments they've been making into their existing home, use that as a deposit on the new family home, thinking, okay, well, I'll rent out the old home and I'll get a tax deduction on the interest payments on the original house. Well, the ATO have a pretty clear view on that, from my understanding, is that, oh, hang on, you've taken those funds out and used the capital for a lifestyle investment. We're not going to give you a deduction on that interest. So you can get a bit hamstrung unless you've established that offset account principle we talked about before, where as opposed to making additional repayments to the loan itself, you plough all your savings into the offset account. And that gives you absolute freedom to do whatever you want with that capital. You can take it out, use the deposit for the new home, and then you are effectively reactivating tax-effective debt
because you haven't been reducing
property.
the limit. You've only been reducing the balance over that time.
Correct, yeah.
And that's really important to note, because the second you change the nature of that property from being an owner-occupied property to an investment property, that again would restart the capital gains tax implications too, from my understanding. So there's lots of implications there if you're looking to not be a rent vestor and maybe retain that old property. It's not as clear cut when it comes to the ATO is pretty smart these days. They will find any opportunity to tax you where they can.
But they are fairly generous, and they'll give you a 6-year window. So from the time that you actually move out of the existing home and convert that into investment property, if you sold it within that 6-year window, it could still be treated as your primary residence and your CGT free, which is a handy one to know, but really good advice to get valuation when you do convert it and get a valuation at the end of that 6-year window.
It's beneficial because most cycles would cross a 6-year time frame. So you'd have an opportunity to sell it. Maybe you've decided to move out of your existing home at the bottom of the market because you see an opportunity you don't want to sell, right? You don't want to rent vest, and you see an opportunity to buy that new home at the bottom of the market, but you don't want to sell. You don't need to sell right now. So you want to keep that property until maybe it's at the top of the market. I guess that cool discount that the ATO does give is that it allows you that 6 years once you've lived in there to rent it out, sell it at the top of the market, and not pay capital gains tax. That's probably a really good way to wrangle the cycle, if you can, to hedge your bets and not really have to do that change out at the bottom of the market that a lot of people do, especially in the last year in Perth. A lot of people have gone, look, I just want to leave, but my house isn't worth what it used to be, but I'll cop it because I can buy a house that also isn't worth what it used to be, and it'll be an equal change out, right?
Yeah.
You don't need to do that.
Yeah, indeed. But the bigger picture for me in those situations is, well, look, you're converting this asset into an investment property. If you are starting with a clean sheet of paper, is this the ideal investment for you?
Would you have purchased this as an investment
If you just had cash in that cash in the bank, as opposed to it being tied up in a property, is that the investment that you would sink all of that capital into?
Yeah.
And if the answer is no, maybe you should be seeking other avenues. Which is what I'm interested from your perspective, Trent. As a financial advisor, we are consulted for what investments should look like for people. But I just get the feeling in the property space, we all think because we're so familiar with the asset class of property, we all think we can do it ourselves, go the DIY route. What do you see in terms of like the value of a buyer's agent in that space? I understand it from wealth management and managed funds and shares and bonds and cash and of the like. What is it from your chair and looking out into the market?
Look, a question that I ask my clients all the time, and I ask myself with my own portfolio, is if I didn't have this property already, would I buy it again? And the answer invariably for a lot of people who have passive holds is no. It's like, well, it didn't work out that well. It hasn't grown that much, especially in Perth in the last 10 years. Most things, probably 80% of properties haven't grown in value. They've probably lost value. So the answer would be no. The reason that most people hold on to their properties is because they feel like they've lost money because it used to be worth something more. The reality is it was never worth anything. It's not worth anything until you sell it. So having the humility and the astute pragmatism to make that sale, if it's what is holding you back from really moving forward with good financial decisions based on the fact that you've learned more, you've got better advisors around you now to invest in better asset classes. It really is something that I praise a lot of people on when they come to me and say, I recognize that the assets I've got that are holding me back from getting more debt, a loan for a new property or equity in that space to afford it is the problem. I've sold them and I've made that decision. I know it's not what it used to be worth, but this is what I need to do to move forward with my life. Rather than spend the next 10 years trying to claw back $100,000, I'm going to do 4 property developments in that time and make $700,000 in that time. It takes a lot of a pragmatism to do that because it also is tied quite closely to our ego, to our sense of self-worth. When you sell a property for lower than it used to be worth, you're sort of like accepting defeat, isn't it?
There's a lot of work that's been done in behavioural finance worlds and the impact of these emotions. And if you're feeling that pressure of, oh, gee, I'm selling at a loss here, you're not alone, because it's been proven in psychological work that they've done, is that this anchoring bias, we're all subject to it, and we've all got our price, that price that we bought the property for, or maybe the agent said, yeah, buy it now, it's going to be worth X in the future, and you anchor that price in your own mind, and it can become an obstacle.
We all seem to anchor the highest price.
Yeah. Absolutely. Yeah, or the market peak,
yeah.
Pre-GFC.
Yeah.
I mean, property prices were fantastic, and you benchmark yourself against that price constantly. Whereas to acknowledge that it's a human trait, this anchoring bias, and
it's paralyzing. It can be really paralyzing to feel out of control, that you just can't make that change to bring the value of that property back up to what it was and how wealthy you felt before, and then to not have the humility to cut your losses. It's not even a loss. Most of the time it's still a gain. It's just not as much of a gain as you used to thought you had. To be able to move forward, that's what I find is one of the biggest hurdles, the most significant issues with people's ability to really invest productively, efficiently, and move forward.
Yeah, and just stepping back on my soapbox, it gives you a really good chance just to assess what you want to achieve with your life. And if, back to your analogy, Trent, and what we're talking about, that blank sheet of paper, what is the mix of investments we actually need to be able to achieve what I want out of my life on a broader perspective? As opposed to just making as much money as quickly as possible, take a broader view, take a breath, assess your goals, and make an informed decision with some good advice behind you.
A lot of people still stick to the understanding or belief assumption that the more properties you have, the richer you are. Now, I would, and you see that on the newspapers, on the magazines. 30-year-old has 45 properties. He must be the richest guy ever. He's always got most of them in somewhere in West Sydney, somewhere you'd never want to live anyway. And he's probably an LVR of 95% and is paying so much LMI, it's unbelievable. But people also, I guess, whenever they have less properties, if they've worked really hard to get 3 or 4 properties and they sell one, they suddenly feel less rich, or their status is lower, as if the number of properties they have is connected to their self-worth. I can tell you what, there's a lot of people out there with one property paid off that have a lot more equity and a lot more savings and are worth a lot more than those people with 10 properties that are maybe at 90%.
Yeah, it's real psychological game, isn't it? I guess in Perth, especially, we've got a rich history of a lot of family wealth has been created through property. So we've also got that history behind us, what we hear about people accumulating sizable property portfolios and how successful we view them as. Whereas maybe the modern day approach is, property is important and you can create significant wealth and equity through it, but you need to also explore other avenues that are available to you. Maybe property isn't going to provide you the highest expected return. Maybe there's something else. Maybe it is. But do your numbers and do your research and take a balanced approach to it.
I think at the end of the day, we started this conversation talking about rent vesting and segueing into a broader aspect of reassessing our portfolio on a dynamic basis. You've brought it in, tied it in at the end now to whether property is the be-all and end-all for your portfolio. And that's why I like having you in, Damon, as a financial planner. It's important to diversify your investment strategy to get the outcome. I would put my hand up and say I'm probably not as diversified as I should be. I'm very long on property because I feel like that's where I'm most comfortable and most confident in understanding the asset I'm investing in. But for those people who aren't professionals in what they invest in, regardless of whether you have a financial planner or not, I think there always needs to be that diversified backup plan. Property probably always is the most risky investment you make because you expect the highest returns, or you should at least, and therefore if you're not getting the highest returns, what are you doing holding the riskiest assets? They need to be working for you or get out. That's my opinion.
Yeah, and with such a large asset, the transaction costs are really quite onerous. So you do need to expect a higher rate of return, to be able to claw those transaction costs back and remunerate yourself for the risk that you're taking.
Damon, thank you very much for coming in, mate. Appreciate it. 18 minutes of gold, as always. Have a good week, and we'll speak to you soon.
Cheers, Trent.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!